Tuesday, April 28th, 1:30 p.m. New York time. Welcome back, investors, to Winning Wall Street's Money. Gonna go over a trade idea, a bearish trade idea on crude oil using options. Gonna include the option chain, methodology, as well as charts, part of the process I use to help determine a trade idea. We're looking at the Tasty Trade desktop trading platform of an option chain. So I'm going to be charting futures as well as the stock ETF, but I'll be taking a trade on the stock ETF. It's a swing trade, a bearish swing trade. So here, the top left is the stock symbol for the stock ETF USO, managed by a company that trades the future contracts. Yep. So the current price of the stock ETF, if I want to buy it right now, the last trade, $140.01. The bid, $140.01. The ask, $140. Whoop, it just changed. So it's a wide spread. It's more than a penny wide. On the left is a watch list I have. This watch list I have here is for me more focused on trading. This watch list here is more focused on option trade ideas. On the column to the left of the stock symbols, on the column to the right of the stock symbols, here's the left symbols. And here's the right of the stock symbols, is the IV rank. IV rank is different on different trading platforms, how they do the math to get the numbers. I use Tasty Trade IV rank, and I added that in my watch list. So for credit options, if you're not familiar with credit options, I have many videos. I discuss those. They're different than debit options. It's the methodology, how you trade them. They are still options, but I'll leave it like this. Credit options can give you a 70% chance, of success. For directional options, you need to be 50-50, just like stocks in the outright direction, and it needs to move fast in your direction. So again, when you buy options, you need the underlying stock on that option to move in your favor very fast. Where credit options, time decay is my friend. And I don't have to have the stock go in my direction. I could have it in a consolidation pattern, like a barcoding. Yep. So again, stock symbol here, USO, current IV rank, 46. This would be updated before the market opens tomorrow morning, or just, at the time of market opening. So I have many videos. I discuss this. It's something I like to apply to help me determine if I want to take a credit spread or a short option. Both of those work for credit. It's not at the high IV as I want. I want it to be at a higher IV. That's not a sweet spot for IV for me. Nope. Not even halfway. That's still not good enough. So that's one thing that's having me decide not to take the trade. But if I was to take this trade, swing trade, I'd be looking for the options nearest 45 days. So in the middle are how many days left in the contract. So the nearest one right here is 38. And the contract is June 5th. So it expires on June 5th. 38 days left. So let me open up the contract. And on the left, the calls, the right, the puts. Again, this would be a bearish trade. Again, the stock is 140. These are strike prices in the middle. Again, on the top, that's how many days, called DTE, days to expiration, 38. Again, DTE, 38 days. Down here are the strikes and a bear call. So let me just cue in. I could take a pretty good hypothetical. Let's do the strike, 150. I'll be selling it. Let's do minimum one wide. Just cue it in. Wow, that's sweet. Okay. So again, when I do one strike wide, I want to collect a minimum $30. That's sweet. So right now, right in the midpoint, it's saying 30. So that's a high probability I can fill that price. I prefer to go wider. So we need to up this. So take the ask, move it 1.5. I don't want to go more than 5 wide because the money management, what I've figured out over years, it'd be better to do multiple spreads and then instead of going much wider because the premium start losing quite a bit of the value in the premium. Yep. So 5 strikes wide, that's $500 margin. And right now it's offering me $112 to pay me. I don't want to do less than 30. So again, 1 strike wide, that's $100 margin. Okay, and I would collect 30. And the short strike right now is 43 delta. Look at that. Currently open interest, 13 contracts in that one. Get low liquidity and 0 on this. Let's go back here on the 155. Look at that. Someone has 1 contract there. Yep. So I'll be selling the 150 call strike. That's called shorting. Selling that. Buying the higher strike, which would be this time 155. Again, shorting the 150. And see the premiums, the bid and ask, they're much higher value. And see the premiums on the 150 strike, they're lower value. So since these are lower value on this long, when you're buying your long, when you're short, when you're selling your short. So that's what's giving me a credit. So I'll be selling the short strike for a higher premium, buying the lower one, and I have a credit. That's it. It's part of the math. Yep. Let's go look at the option charts. Using the futures, top down, chart. Looking here at 20 years, each candle's a month. We're near the end of the month. This monthly candle is almost done. Zoom in. This yellow candle is the month of April. It hasn't taken out the high or low of last month. That means indecision. Big wick on the top and bottom, small little body. That's a dodgy candle. That means indecision. Almost like a dragonfly. Yeah. That's not good. It's indecision. Let's take it to the lower time frame. Now we go to the weekly. A 5-year chart. Each candle's a week. The bottom yellow horizontal line is the low of the year. The top horizontal line is the high of the year. And here we are right now. See the green candle on the far right? We already broke the high of last week, which happened to be an inside candle. That's good. So currently for the week, it's bullish bias. But these 2 big red candles, big, huge bodies, not such big wicks on the bottom. And the 2 current weeks, the prior one, the inside candle, the hollow, equivalent to a green, and current candle green. But the 2 candles here, the green and the yellow, both still inside the range of that big red candle and smaller trading range. So it shows me a history here. It shows me the history. The bears have been stronger. The bulls have been weaker, going up on weakness. I have a gap down here that's not even been tested yet. Yeah. Now let's take it to the daily time frame. We had 2 inside candles there. Wow. And it broke above it. I already have a wick forming. Yep. So we had a consolidation here. 2 inside candles broke above it. Swing high here, potential target on the upside. Look, we just broke back above $100 here on the top left again. So that's a concern too, that we might test this and go higher. I'd rather be shorting at the higher price than have it being shorted and having it get closer to testing my short strike. Now we're on a 4-hour chart. Oh, my fault. Let's go back to the 4-hour chart. Here's the 4-hour chart, 30 days 4-hour chart. Intraday on the futures. We had a consolidation here. I drew this out. This is a key level. This red zone, it's a bearish zone of sellers. We had a consolidation there. I'll zoom in more. We had a consolidation up here. Huge impulse move down. Look at that big red candle. Went down and continued going lower and lower. Coming back up, I showed you on the weekly. we've been coming up on weakness. And again, we had this consolidation and big impulse move down. So this is a supply zone of big, strong sellers. We'll see if we get a retest of this top. We'll see if we can break above it or rejection. Well, today, because I had an alert go off this morning, see this red horizontal line? That was a swing high. We broke above it. High, that green candle, broke above it. The momentum continued going on the upside. Again, I showed you on the higher time frames. The weekly, we're going up on weakness, not strength. And then this green 4-hour candle here, zoom in some more. That's a bearish pin bar, a rejection before it even got in this zone. And I'm expecting this wick to be retraced partly, and that's what's happening right now. What's interesting is after that 4-hour candle, bearish pin bar formed. Okay, we did a retest, a part of it. That's what I'm expecting. And we did an inside candle. That's not cool. So the momentum's still on the upside because we didn't break the high of that green candle nor the low. Again, showing indecision, even though it's a dodgy candle, little bodies here, little bodies, big wicks on the top. Again, showing more bears and stuff in. Again, makes me more want to jump in and take the short right now. And we have this current inside candle. And this would be done at the close of market. And the other concern that I have, situational awareness. If you're following me, you should already know. I've been sharing it every week, every few days. Tomorrow is the FOMC. So my thought is some of these financial instances, they might be goosing up, or goosing down. Wall Street. Wall Street's the traders. If you trade, you're a Wall Street trader. If you sit on the sidelines and don't trade, you're a spectator. Yeah, so because of that big event tomorrow, maybe they're goosing up more tonight or tomorrow morning, and maybe tomorrow after that event, 2 p.m. Eastern time, might be the sweet spot. It's another reason I'm hesitant taking any new trades today. Yep. So now let's take it to the stock ETF. Here's the stock ETF USO. See, I got the stock symbol cued in on the top left. And that bear call spread I mentioned, let's zoom in some more. The current stock is $139.98. Again, that's a stock ETF. I showed you the futures. Again, they're structured different prices. Well, the 150 strike is up here. So long as it stays below that short strike, I'm fine. So the stock can still go higher. As long as it doesn't touch that or go above that, I have a higher percentage of chance to win. Got it? Whereas if I buy puts right now, expect the stock to go lower. If the stock goes higher, I'm immediately losing. It's a beautiful thing about options and advanced strategies. Yeah. Okay, it doesn't even mean I'm going to take the 150 short strike. I could move it further away, but it collect less. Which let's go back to the option chain. Let's clear this. Let's look for the 30 delta right there. The nearest is 29 delta. So 165. And let's do 5 wide is the 170. So I would only click in 5 strikes wide, $500 margins. I would only click $70. Where the other one I showed you when I was doing the 150 strike short, that was 5 strikes wide. I would click more money. So further away, less money. Now, if I want to do the other math formula, looking for the sweet spot, there's one. The 16 delta right there. See the 16 delta is 185. Still do 5 strikes wide. And that's 190. Yep. So the short 16 delta, the long the 190, collect 65. It's lower risk. Still a good amount of money, but again, you're tying up $500 margin on each of these contracts I do. What's the advantage of 16 delta? Oh, I just changed 17 delta. 16 delta and 8 delta. Yep. Those are significant numbers too. I explain those in my videos. Not going to spend much longer in this video, go line by line, each detail. I want to keep it short and simple, focus more on the trade. Closes out. Back to the chart. Go back to the 4-hour. Here we go on the 4-hour. And the daily. So the daily is strong. We already know it broke above and trading above the prior candle from yesterday and the candle itself today. Green. It's above midpoint of its trading range. That's good. Still got time before the markets close. I'll come back around 3:30 and relook at everything. I'll make a determination. So you see some of the reasons why I chose not to take the trade on this particular strategy. Again, credit options, credit spreads, short strikes. Thank you as always, spending a little time with me. That's it for the video. Thanks for watching. Oh, the other thing is all my bullish oil trades, I closed this morning for profits. Yeah. So I'm in cash for those oil trades. And I'd rather be in cash than in positions when this FOMC meeting comes tomorrow.